to, and then we had the next week in which the market declined significantly. So what we want to do on increased volume. So what we want to do is look for an opportunity actually on May 3rd, the beginning of that week, to go short the market. So let's go back to our Analyze tab, and we want to go to May 3rd, the beginning of that week. And then we want to look at the daily chart for the starting on May 3rd. We had already had one large bar down on the weekly chart, remember. So we want to begin looking on May 3rd, which is right here, for an opportunity to go short. Fortunately for us, the first day of May, after the, remember we had those two, we had 1 week of a extreme down red bar on high volume. So now we're looking at May 3rd. Let's go back to the weekly chart again. You can see here that we had that 1 week down right here that was on high volume for that week. So we're looking on the next week, that's May 3rd, to actually take a short position in the market. Let's go back to the daily chart. So May 3rd, it happens to be right here. Now obviously if we're trading during the day, we'd like to we'd like to get the best position we possibly can, but we decided to wait till the end of the day, and we're going to take a position at the end of the day. And we like a delta between 88 and 95. Well, we have one here at 90, so I'll decide to take that. Now for our exit, remember, we're going to be looking for a wide-ranging day on higher volume, and it looks like the potential for the market for buyers to be coming into the market, and that would be this day right here, which is on May 6th, just a few days later. And not only that, but we'd like to be able to, of course, sell our option during the day. Unfortunately, this facility does not give us the option to do that. It only gives us the option of selling at the end of the day prices. So if we go to May 6th, we go back to our chart, even though the market declined significantly, we probably would have made much more money by selling our put option at a much lower price down into this area right here. However, because it's the end of the day, and ThinkBack does not allow us to sell in the middle of a trading day, we have to take the best price we can at the end of the day, but it still gives us a $748 profit. So we timed that correctly based on our assumption that volatility will increase. But I also want to draw your attention to something else. Look what happened to the volatility. The implied volatility went from 17% to 33%. And part of the premium of the option at the 125 put option that we purchased on the SPY is because of that additional volatility. That's how I take advantage of volatility if I know it's going to be increasing. If I know volatility is increasing and we know it based on this high volume day with a wide-ranging red bar after a rally previously and also having a low volatility, a low implied volatility for this option trade. Let's go back to the date that we traded, which was May 3rd, and you can see that the volatility at that time was just 19%. If we go back even further, prior to that one big down week that we had, and we go back to April 19th, you can see the volatility was only 17%. So the volatility exploded from 17% to over 33.46% in just a matter of about a week. That's a huge move, and it's responsible for a number of different opportunities. But the biggest opportunity that we had was that when volatility was low at 17%, and then we saw this large move coming, and we were looking and aware of an opportunity for the next week to take advantage of the increased volatility that we saw. Even then, at that time, volatility had only gone to about 19%. Still early enough for us to get involved in this trade. And that is the type of opportunity that you want to take advantage of when you see volatility increasing. All right, in the next video, I'm going to show you a couple more examples of high volatility trading, and we'll also take a look at what you should be doing to trade in a high volatility environment.